What if I told you that the stock you think is the safest because it's cheap might actually be the most dangerous one in your portfolio? And the reason beginners lose money is not because they choose the wrong company, but because they fall in love with the wrong price. And once you understand this psychological trap, you will never look at stocks under $10 the same way again. Beginners in the U.S. stock market are naturally attracted to stocks under $10 because the human brain is wired to associate low price with low risk and high opportunity. And this feeling of affordability creates instant emotional comfort. Because when someone sees a $5 stock, it feels reachable, manageable, and safe, as if the downside is limited, even though, in reality, a $5 stock can easily fall to $1 and erase 80% of their capital, while a $200 stock might only move a few percent in the same time. But the beginner's mind does not calculate risk in percentages. It calculates it in dollars. And losing $2 on a $5 stock feels small compared to losing $20 on a $200 stock, even though the percentage loss is exactly the same. And this is where the illusion begins, because the brain focuses on the number and ignores the impact, making cheap stocks emotionally attractive even when they are financially dangerous. Another powerful reason is the excitement of quantity, because buying one share of a big stock feels boring, but buying 100 shares of a cheap stock feels powerful. It creates a sense of ownership, control, and potential. And psychologically, it feels like you are closer to wealth because you own more pieces, even though the value of those pieces is the same. And this emotional satisfaction tricks beginners into believing they are making smarter decisions, when in reality, they are simply responding to how the numbers look on the screen. Then comes the dream factor, the fantasy that every beginner secretly carries. The idea that a small stock today could become a giant tomorrow, that a $2 stock might turn into $20 or even $50, and suddenly their small investment becomes life-changing money. And this dream is heavily influenced by stories of early investors in companies like Amazon, Tesla, or Apple. But what beginners forget is that those companies were not cheap because they were weak. They were cheap because they were unknown. And most cheap stocks today are cheap because the business behind them is struggling, not because the market has missed a hidden gem. And this difference is what separates investing from gambling. Stocks under $10 in the U.S. market are often small-cap or micro-cap companies, which usually means they have unstable revenue, weak cash flow, heavy debt, or unclear business models, and such companies survive on hope rather than performance, making their stock prices highly sensitive to rumors, news, and speculation. And this volatility attracts beginners because fast movement feels like opportunity, but in reality, it is danger disguised as excitement, because a single bad earnings report, a failed product, or a change in market sentiment can crash the stock in minutes, and beginners are rarely emotionally or financially prepared for that kind of shock. Another hidden reason beginners are attracted to cheap stocks is that they feel excluded from expensive ones, because a stock trading at $500 seems like it belongs to rich investors, institutions, or professionals, while a $5 stock feels like it belongs to them, like it is designed for small investors. And this sense of inclusion creates confidence, even though modern markets allow fractional shares, meaning anyone can own a piece of any company regardless of its price. But most beginners do not think in terms of fractions. They think in whole shares, and whole shares of cheap stocks feel more real and more achievable. Social media also plays a massive role in this attraction, because most hype-driven stock discussions focus on low-priced stocks that promise fast returns. And when beginners see posts saying a $3 stock is about to explode, it feels like a rare chance to get in early, to be part of something before the crowd. And this fear of missing out pushes them to act emotionally rather than logically. And once they buy, they become emotionally attached to the stock, defending it, believing in it, and ignoring warning signs because selling would mean admitting they were wrong. Cheap stocks also create a false sense of diversification because beginners think that buying many different low-priced stocks spreads their risk, when in reality, they are often buying multiple weak companies in the same risky category, multiplying their exposure instead of reducing it. And this gives them a feeling of being smart and strategic, while they are actually increasing their vulnerability to market downturns. Another dangerous belief is that cheap stocks cannot fall much further because they already look close to zero. But this is a misunderstanding of how markets work, because a stock does not stop falling just because it looks cheap. It stops falling when the business becomes strong, profitable, and trustworthy, and many low-priced stocks continue falling for years until they are delisted, merged, or bankrupt. And beginners who enter them hoping for a bounce end up trapped, holding positions that slowly lose value while their capital is locked and their confidence erodes. Professional investors understand that price is not value, and value is not price, and they never ask how cheap a stock looks. They ask how strong the business is, how stable its revenue is, how reliable its management is, how competitive its industry is, and how predictable its future cash flow is. And this is why many high-quality companies trade at high prices, because the market trusts them, while many low-quality companies trade at low prices because the market doubts their survival. Beginners, however, start from the opposite direction. They start from the price and try to justify the business later, which is why they are drawn to stocks under $10, because it feels like they're getting more for less, when in reality, they are often getting less for less, but with more risk, more stress, and more emotional damage. The attraction is not logical, it is psychological. It is built on the desire to feel smart, early, powerful, and lucky, and cheap stocks satisfy all of these emotions at once, making them extremely tempting for anyone who is new to the market. Over time, many beginners learn this lesson the hard way, after experiencing sharp drops, unexpected losses, and long periods of stagnation, and they begin to understand that stability is more valuable than excitement, predictability is more valuable than hype, and consistency is more valuable than dreams of sudden wealth. But until that lesson is learned, stocks under $10 will always look like hidden treasures, even when they are often warning signs rather than opportunities.